Today, we are cracking the code on the universal language of global business, International Financial Reporting Standards, or IFRS for short. This is the rulebook that the world's biggest companies use to tell their financial stories, so let's dive right in.
So, picture this. You're an investor and you're looking at two really promising companies. The only catch? One is in Tokyo, reporting in yen, and the other is in Toronto, reporting in Canadian dollars, and they're both using completely different accounting rules. How on earth do you make a real apples-to-apples comparison? Well, that's a huge challenge, and it's the exact problem that IFRS was born to solve.
And here is the solution: IFRS. Honestly, the best way to think about it is like a universal translator for finance. It's one single, high-quality set of rules used in over 140 countries, all with a simple goal: making sure a financial statement tells the same kind of consistent, transparent, and comparable story, no matter where in the world that company is based.
Now, to really see how these standards work in practice, we're going to follow the journey of a fictional company. We'll start with its first big step onto the global stage, then look at the rules for its day-to-day business, see how it expands its empire, and finally explore how it tells its complete story to you, the investor.
Okay, so our company has made a huge decision. It wants to go public on an international stock exchange. This is a massive move, and the very first thing it has to do is switch its accounting from the local rules over to the global standard, IFRS.
And that's a huge question, right? You can't just flip a switch and be done with it. There's actually a specific standard designed for this exact moment in a company's life. It's called IFRS 1.
This whole transition is handled by IFRS 1. So let's say, under the old local rules, our company had some machinery on the books for ₹1,000,000. IFRS 1 actually allows the company to revalue that machinery to what it's truly worth today, its fair market value. So let's call that 1.2 million rupees. This deemed cost makes sure that the company's very first IFRS balance sheet gives a true and fair view right from day one.
All right, our company is now officially playing on the global stage. It's up and running, which means it needs rules for all the normal, everyday things a business does, from paying its people to managing its big assets. Now, this is a really common scenario, especially for startups and tech companies. Offering shares or options is a fantastic way to motivate your team. But here's the thing: from an accounting point of view, it's not free. So how do you actually put a number on that? Well, IFRS 2 lays out a clear four-step process for us. First, the company grants the options. Simple enough. Then it has to figure out the fair value of each option, let's say 50 rupees. That gives us a total value of 50,000 rupees. But, and this is the crucial part, it doesn't expense that all at once. If the employees need to stick around for 2 years to actually get those options, the company spreads that 50,000 rupee expense out over those 2 years.
Businesses evolve, right? Needs change. And sometimes a company decides that a big asset, like a factory, is no longer part of the plan and puts it up for sale. The second that decision is made, the accounting rules completely change for that asset. It's not just equipment anymore. It's now officially an asset held for sale.
And this scenario is exactly what IFRS 5 covers. So if that machinery was on the books for 500,000 rupees, but its real market value, minus any selling costs, is only 450,000, the company has to write it down to that lower number. And another really key thing happens. The moment it's classified as held for sale, you stop depreciating it.
Okay, so we've talked about physical stuff and paying people, but let's be real. Modern companies are swimming in financial instruments. We're talking stocks, bonds, loans, you name it. This is a massive, complex area, and it's all governed by an absolute powerhouse of a standard, IFRS 9.
You know, at its heart, IFRS 9 is all about reflecting why a company is holding an investment. It asks two simple questions. First, is the goal just to collect the interest and principal payments? And second, what's the business model? Is the plan to hold this thing long-term or to sell it? The answers to those questions decide everything, and they push the investment into one of 3 buckets that determine exactly how it's valued on the books.
But maybe the biggest revolution IFRS 9 brought in was this idea of expected credit loss. See, before, companies pretty much waited for a loan to go bad before they recognized the loss. This was a direct lesson from the 2008 financial crisis, where banks were slammed for recognizing losses way too late. Now, IFRS 9 forces companies to be forward-looking. They have to estimate the losses they expect to have in the future and book those losses today. It's a game changer.
Our company is doing great. It's operating smoothly under IFRS, and now it's ready for the next logical step in its journey: growth by acquisition. It's time to go out and buy another company.
Buying an entire company is obviously way more complex than just buying a new machine. You're not just buying buildings and inventory, you're buying a brand, a loyal customer base, and all of its future potential. So how does accounting even begin to capture that?
Well, IFRS 3, the standard for business combinations, gives us the formula. And honestly, it's pretty straightforward. You just take the price you paid for the company, let's say $10 million, and you subtract the fair value of all the tangible things you can identify, which in this case is $8 million. That leftover amount, that $2 million, has a special name: goodwill.
So what exactly is this $2 million in goodwill? Well, it's the premium you've paid for all the stuff you can't really put your finger on. It's the value of the other company's amazing brand reputation, its strong customer relationships, its talented team, and all the great things you expect to happen when you combine the two businesses. It's the magic, intangible stuff.
So the deal is done. You officially own this new subsidiary. But you can't just have two separate sets of books floating around. Investors need to see the financial picture of the entire group as if it were one single company. And that process is called consolidation.
IFRS 10 gives us the rules here, and it all boils down to one simple but powerful word: control. And control is more than just owning over 50% of the shares. It's a three-part test. 1. Do you have power over the subsidiary? 2. Are you exposed to its profits and losses? And 3, can you actually use your power to affect those profits and losses? If the answer is yes to all three, you consolidate.
So our little company has now become a complex global empire. It's got multiple divisions. It's exposed to all sorts of financial risks. And just reporting one single profit number at the end of the year, that's not going to cut it anymore. Investors need way more detail to understand what's really going on under the hood.
And this is where two really important disclosure standards come in. First up is IFRS 8, which is for operating segments. It forces the company to break down its results so investors can see exactly how the electronics division, the software division, and the consulting division are all performing individually. It basically answers the question, where's the profit really coming from? And then you've got IFRS 7, which is all about risk. It makes the company disclose its exposure to things like credit risk, market risk, or liquidity risk. It's about laying all your cards on the table.
So we've followed our company from its very first day as a public entity all the way to becoming a global giant. But the world of business never, ever stands still, and neither does financial reporting. The story is always evolving.
And that brings us to a final thought. You know, for decades, financial reports have been all about profit, assets, and debt. But as the world starts demanding more transparency around a company's environmental and social impact, the very definition of reporting is expanding. New standards for sustainability and climate disclosure are being written as we speak. This global rulebook is constantly being updated, which leaves us with one big question. What story will the financial statements of tomorrow tell?